studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Up to this point, we have learned that TOSI can apply when dividends are paid to certain family members and related individuals. However, an important concept to understand is that TOSI is not necessarily the final result. In many cases, the real objective is to determine whether the shareholder can qualify for an exception that allows them to avoid the TOSI rules altogether. A useful way to think about this is as a train journey. Once a dividend is paid, the TOSI review begins. Unless an exception can be established, the dividend is effectively placed on the TOSI track and begins moving toward an undesirable destination: taxation at the highest marginal personal tax rate. For taxpayers and advisors, that is not where we want the dividend to end up. The goal is to find a valid exit route before the TOSI train reaches its destination. Fortunately, the tax legislation provides several potential exits. These exits take the form of exceptions built into the TOSI rules. Some of the most important exceptions include the excluded business exception, the excluded shares exception, the reasonable return exception, and several other specialized relief provisions. Each exception offers a potential pathway away from TOSI and back toward normal dividend taxation. However, these exceptions are not automatic. The taxpayer must satisfy the specific requirements of the exception and be able to support the claim with appropriate facts and documentation. This is why experienced practitioners do not stop their analysis when they see that TOSI might apply. Instead, they immediately begin searching for available exceptions. Their focus shifts from identifying risk to finding a legitimate route out of the TOSI regime. As we move through the next sections, we will examine each major exception in greater detail and learn the conditions that must be satisfied to qualify. The key takeaway from this slide is simple. TOSI may be the starting point, but it is not always the final destination. The objective is to identify and properly support a valid exception before the dividend reaches the TOSI outcome of taxation at the highest marginal rate. At first glance, the various TOSI exceptions can seem unrelated. We have the excluded business exception, the excluded shares exception, the reasonable return exception, and several other specialized rules. It is easy to view them as separate pieces of legislation that must be memorized individually. However, there is a much simpler way to understand them. Every exception is really trying to answer the same fundamental question: why should this dividend avoid the TOSI rules? In other words, what makes this particular dividend different from the type of income splitting arrangement that TOSI was designed to prevent? The excluded business exception focuses on active involvement. If an individual has been regularly and meaningfully engaged in the business, the tax law may recognize that contribution and allow the dividend to avoid TOSI. The excluded shares exception focuses on ownership characteristics. In certain situations, qualifying share ownership can support normal dividend taxation even when other exceptions may not apply. The reasonable return exception takes a different approach. Instead of looking only at ownership or participation, it examines whether the return being received is reasonable when compared to the individual's contribution of labor, capital, risk, or other factors. There are also several other exceptions and special relief provisions that apply in specific situations. Although the technical requirements differ, they all serve the same purpose. They provide a pathway for demonstrating that the dividend deserves treatment outside the TOSI regime. Notice the common theme. Each exception attempts to establish a genuine connection between the shareholder and the business. The stronger that connection, the stronger the argument that the dividend should receive normal tax treatment. This is why experienced practitioners do not study exceptions in isolation. Instead, they view them as different tools that help answer the same question. Can we demonstrate that this dividend is supported by meaningful ownership, contribution, involvement, or economic risk? The key takeaway from this slide is that the exceptions may look different on the surface, but they share a common objective. Their purpose is to prove that the dividend deserves normal dividend treatment rather than taxation under the TOSI rules. When dealing with TOSI, having a structured process is often more valuable than knowing every technical rule. This checklist represents the practical approach that experienced tax practitioners use when determining whether a dividend can qualify for an exception. The first step is identifying exactly who received the dividend. Before analyzing any rules, you need to know which shareholder is involved and what their relationship is to the corporation and the business owner. The second step is determining the shareholder's age. This is important because several TOSI provisions and exceptions depend on age, and different rules can apply to different age groups. Next, evaluate the shareholder's contribution to the business. This is the foundation of most TOSI analyses. Did the individual contribute labor by working in the business? Did they invest capital? Did they assume financial risk? Did they participate in management or decision-making? The answers to these questions help identify which exceptions may be available. Once the facts are clear, begin evaluating potential exceptions. Depending on the circumstances, this could involve the excluded business exception, the excluded shares exception, the reasonable return exception, or another specific exception within the legislation. After identifying a potential exception, the next step is gathering supporting evidence. This is where many files succeed or fail. The taxpayer should be able to support their position with documentation such as timesheets, payroll records, shareholder registers, investment records, meeting minutes, loan guarantees, and other relevant evidence. The final step is documenting the conclusion. A strong tax file should clearly explain the facts, identify the exception being relied upon, summarize the analysis performed, and include the supporting documents that justify the conclusion. If no exception can be supported, the dividend may remain on the TOSI track and be taxed at the highest marginal personal tax rate. However, if a valid exception is identified and properly documented, the dividend may qualify for normal dividend taxation. The most important lesson from this slide is that successful TOSI planning is not about avoiding the rules. It is about carefully analyzing the facts, identifying a legitimate exception, gathering evidence, and documenting the position properly. Strong documentation is often the difference between a defensible tax position and a costly reassessment.